Hey people, thanks for tuning in. The Momo reversal, is something I've worked on for a very long time in the past. I went to Florida to do some mentorship with a trader. Her name's Toni Hansen, and she first introduced me to this concept, and then I did further work on it to refine it to what you see in front of you here. And this is something that was originally going to be part of a course that I was putting together, but it didn't come to fruition. I didn't bother to finish the course, and so I've just decided to share it for free here today. For anyone who might be interested in cultivating an edge, anyone who's got the patience to wait for this pattern and trade it as per the instructions in this video, will see positive results. I've got spreadsheet after spreadsheet of hundreds of trades which prove the viability of this edge. It will work in any market with volume. I've used it on anything from stocks to futures, particularly futures is what I tend to use it on. Although I'm not currently using it right now because, quite frankly, I don't have the patience to wait for the pattern. So I found or created something else that's more mechanical, and this is a bit more artistic. So if this is your thing and you have a screen in front of you, whether you're at work or you're at home or whatever the case may be, and you have a couple of hours a day, you will be able to, if you monitor 3, 4, 5 markets, futures markets, so that can be the Forex futures, the indices, crude oil, gold. I've traded gold, crude oil, all of the indices, the NQ, the YM, the ES, all the Forex futures, 6A, 6B, 6C, 6J, anything like that, and you will find this. I would advise you to either use a tick chart or a 1-minute chart so you can see the pattern properly. 5-minute charts will give you bigger rewards, but you'll have to take bigger risk, and so a 5-minute chart would be more suitable for an intraday swing trade if you want to put on fewer trades per week and have a slower pace of management. But if you want to get the job done like I did in an hour or two a day, then a 1-minute chart is the way to go. So without further ado, I introduce you to the momentum reversal. Enjoy.
The Momo reversal is comprised of 3 main characteristics or components. Magnitude, which is the physical length of waves, be it impulse waves or corrective waves. Pace, which is a given amount of price increase over time. So price increase or decrease over time. And volume, which we've discussed in a prior segment. So how exactly do these combine to create this specific pattern? Well, you can see here we have a 5-wave pattern comprised of 3 impulse waves, which are labeled 1, 2, and 3, and then 2 corrective waves, which are the 2nd and 4th wave of the pattern. Impulse wave 1 should be steeper, should be more bullish in pace than impulse wave 2. That is, impulse wave 1 has more of a price increase, in this example, over a given period of time than 2 does over the same said period of time. The same relationship is true for impulse wave 2 compared to impulse wave 3. So that is pace. Magnitude is the same, that is, impulse wave 1 is bigger than 2, and 2 is bigger than 3. There is a rule governing how big they should be, and that is impulse wave 2 should not be any less than 50% of impulse wave 1, but it shouldn't equal or surpass the magnitude of impulse wave 1. So it's between 50 and 100% in length. And the same relationship holds true for the comparison of impulse wave 3 compared to impulse wave 2. That is, 3 should be bigger, greater than 50%, but less than 100% of impulse wave 2. So that's magnitude. And then finally we have volume, and we'll show this with some examples of live or actual trading price charts. But in a nutshell, volume should fall off over the pattern. So much the same relationship as pace and magnitude, declining volume in each successive wave. The distance between A, B and C, as depicted on this chart, that is the ends of each impulse wave, is governed by the same law of magnitude. That is, the distance between B and C should be 50% or greater, but less than 100% of the distance between A and B. Here are some examples. We have 3 examples here. 2 are incorrect, and only one of the 3 examples you see in front of you is correct. Which one is correct? It is example number 2. More importantly, why is number 1 and why is number 3 incorrect? Well, number 1 has everything but the magnitude in check. That is, wave 3 is significantly less than 50% of wave 2. And when I refer to wave 3 and 2, I'm talking about the impulse waves. In 3, we have everything in place except for the distance between the ends of the impulse waves. That is, point B, which is the end of the second impulse wave, and point C, which is the end of the third impulse wave, has a distance that is greater between them than the distance between point A and point B. That is the end of the first impulse wave and the end of the second impulse wave. And so that's what negates that pattern. One more example here, using a long patterns this time. 1 is correct, 2 are incorrect. Which is which? Number 1 is correct. Has everything in order. What does number 2 have that is incorrect? Simply pace. Pace on the third impulse wave. This time our impulse waves are pointing down, as it's a long pattern, and our corrective waves are pointing up, and the reverse is true for shorts. So the third impulse wave is steeper than the second impulse wave. The same is true on the third pattern. That is, the third impulse wave is steeper than the second impulse wave. So here is an actual example of a Momo reversal to the short side. But before I go on with analyzing this example as it pertains to the 3 components which we mentioned a bit earlier, magnitude, pace and volume, I just wanted to touch on a subject which we'll delve into deeply in the money management section, and that is entry and stop. You have 2 types of entry available to you, as I see it, and that's anticipatory or reactionary. And there are pros and cons to each, and we'll discuss that in more detail later. And then with the stop, you can have a statistical stop. That is a given amount of ticks or pips or points which you've personally researched, regardless of structure. Or you can have a situational or structural stop. That is, you can go above a bar high or low, or below a bar low. You can go above a swing high or swing low, those sort of things. Structural, what you see on the chart. So looking at this example, the momentum reversal is here. Here is impulse wave 1 with its accompanying volume. The woods are here, the trees other volume spikes there which are 180 or 200% more than any of the woods. That's the way you can tell. So here's another example here, a tree sticking out of these woods. You can see the woods creeping up and then declining here, which dictates the end of the wave. So that's impulse wave 1. Then you have the corrective wave. Then you have impulse wave 2. Again, woods, trees. And then finally impulse wave 3. So how would you enter? If you were going anticipatory, you would look at the length of impulse wave 2 as compared to impulse wave 3. You know it can't go over 100% of the wave of the length, the magnitude of impulse wave 2. So you use that knowledge, and you know it can't be less than 50% of wave 2. So once you're within those boundaries, you look for a reversal sign. One way is volume. You can see the volume increased on this bar. It's 163 there. Let's bring this over. 163 volume. This green bar is 168, so it's increasing. And then here we get only 39, despite the high or the break of this little ledge or numerous four bar highs there. You get the break, higher high, lower volume. You could enter straight away there, in which case you would enter at 67.75, and then the trade would be on. It goes 2 ticks against you and proceeds to drop to 2.5 points or 10 ticks in your favor in the next 15-30 seconds. That's anticipatory. Reactionary would be a trigger of a reversal bar. So for example, 67.25 under this little reversal bar here, in which case price would go 1 point against you. That's 4 ticks, and then you'd get your 10 ticks or 2.5 points. And a third possible way, or a second reactionary entry, would be a channel break, and this is the lowest risk to reward of the bunch. That is, you get relatively less reward for your risk, because you would have got in way down here at 66.75 on the break of the channel, and it goes 1.5 points against you before then going 65.25. So you get 6 ticks for it. Went 6 ticks against you and then went 6 ticks in your favor. 2 for 10, 4 for 8, 6 for 6. Those are the different risk to reward scenarios there. Those are a few of the ways you could have entered that trade. So to summarize, volume, we have the woods, we have the trees. Let's see if it fits our criteria. Where is A? Well, this is a very broad top, so I'd take the middle. A is about there, B is there, and then if we draw along to C, you'll see that it's greater than 50% but less than 100% of the distance between A and B compared to the distance between B and C. So the peaks meet our requirements. Wave 1 is bigger than wave 2 in terms of magnitude, and 2 is greater than wave 3. Wave 3 is between 50% and 100% of wave 2. I know that wave 2 isn't between 50% and 100% of wave 1. It's significantly less than 50%, but that's an exception, a different type of momentum reversal, which we'll get into in a later video. Pace is complying and volume is complying. Okay, so here's a final example before we wrap this video up. This time it's not a short, it's a long. So let's look at this in terms of impulse waves and corrective waves. You can see I've drawn on the impulse waves here. Impulse wave 1 down is the largest and most bearish in pace of the 3 impulse waves. The second impulse wave, which is between 50% and 100% of the magnitude of impulse wave 1, is less bearish in pace. It also has less volume. And then finally you have the third impulse wave down, which is the shallowest in bearish pace, as you can see by the inclination compared to wave 2, and it's also got the lowest volume as well. So this is a picture perfect momentum reversal, and the magnitude is greater than 50% but less than 100% of the magnitude of impulse wave 2. The corrective waves just so happen to look favorable for upside, but that's not a prerequisite of the pattern. The distance between peaks B and C is greater than 50% but less than 100% of the distance between peaks A and B. So how would we enter? We would enter, let's get in close here. You have, for a reactionary structural entry, you could have any number of, dependent on how you drew that in, perhaps an entry here at 98.25, in which case you would have needed a stop greater than 1.75 points to survive that and gain from the trade. Or if you didn't take the wick and you were waiting for a close above the line, then you would get something lower, perhaps 97.75, in which case a 1.5 point stop would have sufficed by one tick. If you got in 97.75, you would have seen 99.75. So 1.5 points risk for 2 points gain. You've got the whole number there, which would be an obvious target, one tick below the whole number. But again, that's out beyond the scope of this this video. Now, if you were doing a more anticipatory entry, you would look at volume as and magnitude as your guide to when to jump in front of the trade, so to speak. So you've got the woods here, and then you've got this big tree, which is much more than 200% of the average height of the woods. So that shows you that yes, we've got exhaustion here. We see a correction. Now we go for impulse wave 2. You see the exhaustion volume here, which is lower in volume than the exhaustion for impulse wave 1. We go for another correction, and then we come down here. We see an exhaustion here, and the volume here is 448 contracts right there at 1650. Now, something you will notice if you look at the volume, and we've covered this off in volume before, is the exhaustion volume doesn't usually occur right at the low. We usually have a retest of the low. So in this case, we have a low of 175. That looks like, no, 2. And here we have a low of 175. It took out the prior low, but it did so much less volume. So that's a divergence. Same thing here. Volume comes in way up here somewhere, as you can see with me floating over the volume, and then we have a retest on lower volume before we have the corrective wave. So what would you be waiting for here? Your volume spike here, 448 contracts, a low of 97. So we need to see 96.75 without as much volume. We see that here, a smaller exhaustion compared to the other woods, and you jump in here, maybe you're getting 97, 97 and a quarter. You take 3 ticks of heat and you get up to 99 and 3/4. 2.5 points for 3/4 point of a point risk. So that's a little, although overall the pattern failed, looking at the bigger picture, you don't need it to quote unquote succeed for you to be able to make money from it. So that's the end of this video, and we'll move on to one of the other 3 patterns in the next video.
So I hope you enjoyed that video. Just to prove that it still works as well today as it did when I last traded it. I think last year was the last time I traded this pattern. I've got Friday's trading in front of me. This was Friday the 3rd of February 2017, so 2 days before I'm putting out this video. And if you watch the video, you'll know that you need 3 characteristics for this trade to form. You need volume, you need magnitude, and you need pace. And then there are some laws governing the distance between what I call high A, high B, and high C for the pattern, and laws governing the length of the 3 waves that make up the 3 impulse waves that make up the pattern, which is wave 1, wave 2, and wave 3. But I won't go into too much detail here because if you've watched the video, you should already know this. So let's just make sure that they match the rules. Obviously, wave 1 is indeed longer than impulse wave 1 is indeed longer than impulse wave 2. Impulse wave 2 is longer than impulse wave 3. I've put on a fib here, anchoring from high A, which I'll just draw like this, and then high B is here, and the distance between A and B, which is 100%, means that the distance between B and C should be between 50%, which is this blue line, and 100% of the projected distance of A and B, and you can see it falls between these 2 lines. And then you have the pace. The pace of wave 1 is steeper than the pace of wave 2, and the pace of wave 3 is steeper than the pace of wave 2. And you can tell by, if I move the line over, you'll see that this one is rolling over more as compared to this one, and this one is rolling over more as compared to that one. And now the volume, clearly you can see volume declining here. You have the trees here, this green exhaustion bar here. You have this green, which now that I think about it, Dave from 123daytrade.com, he talks about stopping volume, and this is probably, I haven't looked at his stuff, but this is probably something similar. And you see the exhaustion volume here and here. This dictates the end of impulse wave 2. And then finally, let's move it to the right side of the screen so we can see it in what would be real time. You know that once the pace is what it should be, you can start looking out for, and the length is what it should be, you can start looking out for the volume. So here's the first volume spike at 335, and then we need something higher than 1.2501 with lower volume than what this volume is. So that's all you look for. When you see that, you hit it. There it is. You enter at 502. Then it's up to you whether you're going to put a structural stop above some kind of swing high, or whether you're going to use a statistical stop, and that's what I would recommend because it allows you to have a tighter risk for a greater reward. So you might choose 5 cents, 6 cents, 7 cents, depends on what your backtest says how accurate you are in picking off the high of wave 3. So let's say you went in here 502. Let's see what would happen if we had a 5 tick stop. So 507. Nothing, no heat. 502, If you've got a 5-tick stop, then already at 92 you've got 2 times your risk. At 82 you've got 4 times your risk. And then it's going to be up to you how you manage that trade out. You can say you're going to exit on a reversal bar after you've got 2 times your risk. You can say you're going to exit at the next support level. And if you did, then you got 4 times your risk there on that trade. So this is a one chart system. You don't need to see any resistance, nothing like that, just all the characteristics that make up this trade. Let's have a look quickly at another one. Here it is here. Sorry, I just got disturbed there. So this sorry. This is another example on 6C. So we did 6B, and that was on the 3rd of February. This is still the 3rd of February. 6C, Canadian US dollar. Wave 1, wave 2, which you could measure from where the chop breaks, or you can measure the whole wave from low point to high point. And then this one here. And now the only thing with this is dependent on how you measure it. If you measure it from, and this is why it's a little discretionary, this pattern, you need to stick to one method of measuring the waves. If you measure from absolute low to absolute high, then this isn't long enough here. But if you extend it across, then then it could be long enough. It's just about 50% of that line, and so you would enter here. Same rules apply. You look at the volume, you can see the volume there, volume here, and then you see a spike here. So when you get higher than that, you get another volume exhaustion bar. That comes at a point where this line is long enough and shallow enough, then you enter. So it's a combination of these three factors: the pace, the volume, and the magnitude have to all come together, and then you pick off your entry. So you would be entering somewhere, you wouldn't enter there because it's not long enough yet. You'd be entering somewhere here on an exhaustion bar. So let's say you went on this here, 97.5. It went to 99, so it went a tick and a half against you and then just dropped off, and you have to choose your exit, be it a support or a reversal candlestick or whatever it may be. That's bigger reward for your risk. That's 6C, and then finally we have 6E. You should be able to spot it there, the Euro US dollar. You have this move up here, and then this move up here, and this one's much clearer. This is about 50% of this wave here. This is about just over 50% of the first wave. They're rolling over in pace. The distance is correct, as you can see by the fibs. We fall between this blue line and this blue line. And then when all of that happens, whenever you see all those attributes combined, you look for your exhaustion volume, and that's right there at 6 o'clock. Let's zoom in so we can get a better picture. Right there, yeah, at 6 o'clock, because we get a higher high but a lower volume bar here. If you look down at 6 as compared to this one, it's 552. So you enter there at 5.5, 805.5. It goes to 808.5, so 3 ticks against you, and then proceeds to go off towards whatever objective you set, be it a support or a reversal candlestick or whatever the case may be. So let's say you get 5.5, it goes 3 ticks against you. You could get down to 99 even, which is 6.5 for your 3 ticks risk. That I would say that that's not enough. You would go down to the next level, 95.5, so 10 ticks for your 3 ticks risk, and you could hold it. You can trail behind highs, in which case you may have got, no, you wouldn't have got taken out there. You can trail along highs and so on and so forth. The way I used to do it for big gains when not scalping is trail behind highs when the lows were taken out. So when this low got taken out, go behind here. This low got taken out, go behind here. This low, this low here, go behind here, and so on and so forth. And so those are just a few examples of how this pattern is still working today. The downside of this pattern is you have to wait. And that's something I haven't been good at recently, hence the reason why I'm not trading this pattern, because it doesn't occur all the time. You have to wait patiently, and when you see this, you jump on it and either get your smaller reward for your risk if you want to scalp and be out of the market quickly, or you can hang around and trail over highs or under lows if the pattern's flipped, because this pattern can be flipped upside down to have longs as well as shorts. So that's all I wanted to cover today. I hope you like the free strategy, and as always, like the video if you got anything out of this. Subscribe if you want to see more videos like this, because I've got three more patterns to share within this methodology and another methodology that I will probably share at some point. And as always, follow your plan and stick to your rules. See you next time.